Wow, revenue has dropped by this much in the last quarter. This slowdown is crazy. So let's take a look at what's going on here. All right. Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company, decide if I was looking for another investment, would I buy or would I pass? Before we start, don't forget to hit that subscribe button to get info on new episodes and other videos. So let's begin. So like always, I'm going to use the website known as lazyfa.com, which allows me to check all these financial numbers in an easy visual format. And today we're going to take a look at Micron Technology MU. They just reported earnings I think it was last week. We'll take a look at the quarterly data and see how things behave. Later this week, I'll probably do one where I take a look at their earnings presentation. But first, let's take a look at their numbers. So here we are in the income statement of MU. We're going to take a look mainly at revenue, cost of revenue, gross profit, net income, and earnings before income taxes. If we see anything fishy, we'll dig in a little deeper. If not, we'll continue to the next statement. So here we have revenue, right? Revenue, we can see there is a slowdown in MU. But the pretty crazy thing is it's not scaring me as I think most people are scared of right now. And let me explain to you guys why. So here we have cost of revenue. So cost of revenue itself has been pretty flat since December of 2016. So December of 2016 cost of revenue was $3 billion. This year was $2.97 billion. Pretty much on par with December 2016, December 2016. So I want to be, this to me seems when MU peaked at its cost of revenue means to me it's a smart company. It knows how to spend its money, right? So that to me is a good thing. So any money made above since 2012, December 2016, I keep saying 2012, December 2016 is a plus. So let's take a look at the revenue in 2016 of December of 2016 was almost $4 billion. So at $4 billion, it kept increasing, we can see here. But cost of revenue itself was pretty flat. Now let's take a look at revenue right now compared to that quarter. So right now we're sitting at $5.83 billion of revenue. That's still pretty high. And we can see here the gross profit, we're still above in the gross profit. We're sitting at $2.86 billion of gross profit. And if we compare it to December of 2016, it was $1 billion. So right when the cost of revenue flatted out, we're still making more money than when that happened. So to me, that is actually great. It means to me we could expect a drop down in revenue, and as long as this company maintains with the strong cost of revenue flatline, then this company should be fine. So next we'll take a look at earnings before income taxes and net income. I don't see any big changes compared to net income and earnings before income taxes. Usually if I see a big differential between there, I try to look at some things between the three, from gross profit to earnings before income to net income. If there's no real difference with how the charts look, and to me they all look pretty much the same, I jump straight to net income. So here net income, we're sitting at net income of $1.62 billion. So this company is still making a lot of cash. And again, I just want to take a look at the December of 2016. In that time, MU was making $180 million compared to today's $1.62 billion, almost 1,000% increase. So to me, MU is not scaring me with this drop. With this drop, I'm not concerned at the moment. Let's see if we can see anything else. Next, we here in the income statement red flags analysis that Lazy FA gives us, and we're just gonna see here, right, revenue versus cost of revenue. Like I've mentioned before, we can see here, right, that cost of revenue has been pretty flat. We slowed down in that revenue, decreasing our gross profit. Here are our gross margins. Our gross margin is pretty cyclical, we can see. And at the moment, again, nothing really scares me away. Profit margin is still pretty high at 27.7. And we can see it does seem to have this cycle up and down, up and down. The only thing is we don't know when that cycle ends, so when the bottom is. But at the moment, things don't look too bad. So I took a look at the red flags that Lazy FA gives us. There's nothing right now that's concerning me here. Some of them are just false, not false red flags, but red flags that were triggered due to some error in past data. So we can continue next and look at the balance sheet. So here in the balance sheet, we'll take a look at assets, liabilities, debt, and cash equivalents. And right here, we can see total assets quarterly has been increasing. Again, pretty good. That's looking pretty good to me. Now I want to see where these assets are mainly coming from. Are they coming from inventory that the company is withholding? Are they coming from intangibles or maybe property or plant equipment? So we'll take a look at that next. Total liabilities, again, I am really liking how this total liabilities is dropping. This, even though compared to last quarter was 9.7 billion, this quarter was 11.96 billion. It was about a $2 billion increase. We're still pretty low compared to previous quarters. So that to me, as long as we're not continuing to build up this total liabilities, right now I'm definitely not scared away of MU. Am I getting a buy? Not 100% sure. We'll have to keep looking at the data. Total debt, again, we can see why that liability is dropping. Total debt at its peak was $12.45 billion in March of 2017. We're at pretty much March of 2019, 2 years later. We're sitting at 6.24 billion. So compared to last year, we had an increase of $2 billion, and we see that in the total liabilities, right? In total liabilities, that was the reason we had that $2 billion debt increase, the liability increase, because of total debt. We increased by $2 billion. But again, this difference between total assets and total liabilities is going to be our shareholder equity, and we're going to see next that is looking really good. Right now, we're at $47.5 billion in assets and about $12 billion of liabilities. Cash and cash equivalent. This company has plenty of cash and cash equivalents, which are just assets that can be liquidized pretty quickly. Right now, sitting at $6.35 billion, about $2 billion higher than last quarter, where we can see, I wonder if this company took out a loan. If it took out a loan for cash, we can see where that money came from, right? So it probably took out somewhere between the $2 billion cash loan. That's why we have that total debt increase, and that's why we see a $2 billion cash increase at the same time. All right, this company definitely has a nice amount of cash to hold. Next, we'll take a look at the red flags from Lazy FA. Here, assets and liability, we can see the huge difference between assets and liabilities, where we see this positive shareholder equity. Right now, we're at peak of shareholder equity sitting at $34.57 billion. That's really high right now, right? We're sitting pretty good looking at this shareholder equity. If I was a shareholder at the moment, I honestly would not feel scared due to that revenue drop. Here, assets, distribution, and we got our answer of where mainly these assets are coming from. These assets are coming from property, plants, and equipment. It has had such a steady increase. To me, property, plant, and equipment is definitely a good thing to have, but for it to be 56.36% of asset distribution, I'm not gonna lie, would throw me off a little bit. I would definitely wish investments were higher asset distribution. But this is a company that's actually making products, so they definitely need the equipment, the plants, and all this to make sure all their products are being made. But we can see their investments are about, probably I want to say close to 18 to 20% of the asset distribution. Again, not a bad thing. I just wish we had a lower property, plant, and equipment asset distribution. But like I said, the type of company, this company needs that equipment to continue and make more products. And then I just want to see how much inventory is. Inventory at the moment is only 10% for such a big company. That's definitely not a bad thing, only being 10% of the assets. Here, liability distribution. This, I'm really liking this dark brown, dark red, non-current debt. And we can see it's paying off. It has paid off a huge chunk of its non-current debt. This is actually pretty crazy. It's non-current debt. It's lower than its payables, which is what the payables are just what money it owes to other its suppliers, right? So that's pretty crazy that it used to be such a huge value. Non-current assets used to be overpowering, that now it's pretty on par with payables, and that to me is looking pretty good. Here we can see current debt increased dramatically in this past quarter. Last quarter was $398 million. This year is $2.63 billion. That this company definitely has the cash to pay it, but I wonder if I wonder if the loan they took was a short-term loan, because that's about a $2 billion increase in current debt. I wonder if they have a short-term loan. We'll find out in the next episode tomorrow, where I take a look at the presentation. They might discuss this, and we'll find out there. But at the moment, liability and assets distribution, pretty happy to see liability, non-current debt being dropped down. A little iffy that current debt is pretty high compared to the normal, and the normal seems to be around 1.2 billion dollars. Right now we're at $2.63 billion. So the non-current debt is definitely a lot higher than normal. Asset distribution, I do like that investments are about 20% of the assets, a little less, maybe 18%. I'm a little not freaked out, but a little wary that property, plants, and equipment are 56% of the assets. But again, this is a company that definitely needs those types of assets to keep producing. Finally, we'll take a look at the cash flow from operations. And this is actually the only one I care about. And the main reason that this is the only one I care about, right, is because it means this company is making money from its everyday use. And we can see right now it's sitting at a pretty high $3.44 billion of net cash from operations. And compared to its revenue drop, it's actually sitting on par with August of 2017 and December of 2017. So again, even though we've had this huge revenue drop, this company is still pretty efficient in keeping its money. And to me, that looks pretty good, pretty damn good. So the next thing we'll take a look at is revenue capacity. So this is something new that Lazy FA added. So here we're going to see revenue, revenue. We're seeing revenue. I think this is the trailing 12 months revenue. So this is the revenue from the past 12 months. And here we're taking a look at the property, plant, equipment right now. So the assets, which was about $26.2 billion, the 56% that we looked. So then revenue capacity is the division. It gives us a ratio. It gives us a ratio dividing the trailing 12 revenue divided by the current property and plant equipment assets. So this gives us a ratio of how much revenue this company is making in the past 12 months based on the property and plant and equipment. And right now we're definitely having a ratio higher than 1. We have a 1.14 capacity. If we had a 1-to-1 ratio, this means this company was making revenue compared to the exact amount of assets from property and plant equipment. So this company, it's pretty crazy how assets and how the ratio is pretty on par to previous. What we can see is a cyclical type data, and we're not sure how low this can go. So that's the only scary part of MU right now. It depends on how much this slowdown goes. But at the moment, it's definitely not a scary thing to me. And finally, we have the net income minus operation cash flow gap. And here we definitely like to see a negative value. So here, right, negative value in this gap indicates that cash from operations was greater than net income. And this is a sign of a positive earning quality. So again, we can see this is pretty negative. So it's definitely a great sign and things are looking good. So before I give my answer, let's take a quick review. Right, revenue has slowed down dramatically. That's definitely not, that's the elephant in the room. Revenue has slowed down dramatically, but that cost of revenue has been pretty flat since December of 2016. And right now we're making more money than there. So that slowdown, it still hasn't hit us hard, and we're still making some great money. Net income of $1.62 billion, right? And we can see revenue versus cost of revenue. In the balance sheet, we can see this increase in total assets, and we can see this decrease in total liabilities. We also have a nice positive cash and cash equivalents. The only thing though is that asset distribution. I'm not 100% not a big fan of that much equipment being that huge percent of assets. And at the same time, I am pretty happy we paid down such a high level of non-current debt. But current debt for this quarter, for this year, is actually pretty high compared to previous years. So that's definitely something to keep an eye on. But this company definitely has the cash, and that to me is not, is again, that doesn't scare me off. It's just something we got to keep an eye on for future quarters. Finally, we do have a positive net cash flow from operations, and it's sitting pretty close compared to like quarter of 2017 of November. So that to me is definitely pretty good. And for me, MU is still a buy. It might not be as big a buy as it was previously, but it's still a buy. I definitely would look into getting more into investing into MU. And just for one more thing, I just want to look at price to earning ratio. It's ratio quarter to quarter, and right now we're still sitting at a pretty decent price to earnings ratio at 3.58. I wonder what the stock price was at that moment, but let's just do a quick calculation. Right now we're sitting at 41.3. Let's do, I'm just gonna assume that we're gonna maintain this 1.45 for the next 4 quarters. Now 5.8. Now 43 divided by 5.8. At 7, this is still pretty cheap in my opinion, right? For a technology company, we're sitting at about 41 actually. 41.33 divided by 5.8. Okay, I'm about a 7 PE ratio. But this is for me assuming this does not increase over time. Who knows? This definitely could increase over time. But for me, at the moment, I definitely would give MU a buy. So I hope you guys enjoyed the episode. Like I mentioned, Lazy FA makes it so easy to look at all this information, which makes these episodes go pretty fast. So make sure to check out the website. I'm curious, would you buy or pass on this company based on the information we just saw? Again, don't forget to subscribe to get updates on new videos and post comments on the company you guys want me to take a look at. Have a good night, guys, and see you next time.